Welcome to the What's Your Deal podcast, where we discuss business acquisitions, investments, management, and exit strategies. I'm your host, Matt Euler. Let's dive in. Well, welcome to another episode of What's Your Deal. I'm joined today with John Bowens with Equity Trust, and I'm so grateful to have him. John and I have known each other for a little over a year now, and he has literally proven to be the expert in this field. And so let me start by reading his introduction to give you a little more background on him, and then he will be able to enlighten us on all kinds of areas that'll be valuable, I think, as you evaluate your options for how to invest and use your funds, even to buy businesses. So John is the Director, Head of Education and Investor Success at Equity Trust. He has a compelling education curriculum that delves deep into the technical aspects of investing within self-directed IRA. John incorporates real-world case studies, current market-focused applications, and excites and energizes and engages his audience in doing so. John, thank you for joining us.
Hey, Matt, thanks so much for having me. Really excited for it.
I appreciate that. You know, Equity Trust is not considered a Main Street business, is it? I think $81 billion in assets, so large company.
Yeah. In terms of, I always like to say, Matt, that in terms of financial services, we're a very small fish in a very large pond. But in terms of utilizing retirement accounts, IRAs, 401ks, rollovers from 403bs, rollovers from TSPs, even HSA accounts to invest in beyond Wall Street assets. So assets like real estate, private money lending, private equity, pre-IPO stock, investments in cryptocurrency, and even physical precious metals. We're definitely the large fish. And so we've been doing this dating all the way back, in fact, to 1974. The predecessor to our company here at Equity Trust started way back in 1974. And our company founder, who's still the chairman of the board, Dick Desich, he's widely known as the pioneer of the self-directed IRA industry. And then I fell into the business nearly 20 years ago. He became my mentor. And so I've been helping to educate individuals on how to utilize their IRAs and 401ks to invest in everything from private stock to private equity, real estate, private money lending, cryptocurrency, precious metals. It really runs the gamut in terms of what you can hold in a self-directed retirement account and really help someone be in control of the investments that they choose for their retirement accounts.
Well, I really appreciate that. And from having listened to you in the past, your depth of knowledge in this area is honestly mind-boggling to me. And I love acronyms. I think you've got more acronyms than I have in our office for things. I mean, there's a lot going on there. So I'm excited to dive into this. And our audience is, to a very large extent, entrepreneurial. They're looking at, accumulating wealth, building on their wealth, selling businesses, buying businesses, investing. And that's why I think it's so great that you've joined us today. So maybe you can just give us a little bit about your business background and how you connected with Equity Trust. And then let's just dive into the meat of this. Like, what is this? How can this help people that are looking to invest in alternative investments?
Yeah. So academically, my background is finance. And there was a point in time in my life where I was thinking about going down the path of becoming a financial advisor, a traditional financial advisor. And so working with individuals and determining what type of portfolio made sense for them, investing solely in public market investments. And that was my upbringing in my background academically, is traditional investments. No one ever told me that I could use an IRA, 401k, Roth IRA, HSA, other tax qualified account to invest in alternative assets, invest in assets that go beyond Wall Street, such as real estate, private equity, private money lending, cryptocurrency, precious metals, all of these unique alternative investments. Or Matt, like you work with a lot, individuals investing in businesses. Mm-hmm. So you can use your IRA or 401k to invest in other individuals' business startups or business opportunities, whether it's a startup or it's a more matured company. Nonetheless, you have the ability to do that with a self-directed IRA. So I knew nothing about this. And nearly 20 years ago, I met our company founder, Dick Desich. And he opened my eyes up to this world of being able to take control of my retirement account and be able to invest in alternative assets. And so that's how I got started nearly 20 years ago. And since then, I've had the opportunity and privilege to educate over 100,000 investors across the country, doing various workshops. I have a book that just came out, Wealth Beyond Wall Street. And so we do a lot of education around using self-directed IRAs and 401ks and other retirement accounts to invest in these, call it hard to value alternative assets, ultimately being able to take control. And personally, I utilize my self-directed accounts. That would be my 401k, my Roth IRA, my HSA, to make private money loans to house flippers primarily, but also some self-storage investments, as well as individual property investments, private equity, cryptocurrency, along with self-directing into publicly traded assets like stocks, ETFs, and mutual funds. So the concept that I've learned going back nearly 20 years ago, meeting our company founder, is that I don't have to be at the mercy of the traditional stock market. I have the ability to take control of my retirement accounts and be able to invest in alternative assets. And that's what I've been helping our clients do as well. Though I always let people know, Matt, that the only thing I don't do is recommend investments or opportunities. And that's why people like working with, myself and the firm in which I represent, is because they have the ability to make their own choice. And there's not an individual that might have a certain lean in terms of what types of investment products to offer because of how they're incentivized or how they're compensated for the advice that they give.
Yeah, it's very powerful. And I'm going to ask you to just share maybe a little bit why somebody might do this, but I'm also a customer of Equity Trust, and I've taken my retirement funds and used them for alternative investment purposes because I like that, right? I mean, I understand real estate investing. I've been doing it for a long time. I understand businesses. And so to be able to have that nest egg that's protected for long term, but direct it the way I want is what's valuable for me. I'm assuming that's what you find with all of your clients, that's the benefit?
Exactly. That's correct. So one is diversification, which is exactly what you said there, Matt. And that's the ability to leverage your knowledge and expertise and invest in an asset class, whether that's private equity or real estate, like you mentioned, could be tax liens and tax deeds, could be cryptocurrency, but really leveraging your knowledge and expertise and applying that to the productivity and the performance of your retirement account. So diversification, number one. Number two is tax efficiency. With self-directed IRAs and just IRAs in general and 401ks in general, there's unique tax advantages. You have what's called tax deferred growth. So some accounts, you're getting deductions when you make contributions. You have tax deferred treatment. So your compounding interest is tax exempt. And then when you eventually distribute the money, that's when you pay taxes. But you have all of that benefit of all of those years of growth being tax deferred. Okay. And then you also have what's called a Roth IRA or Roth 401k, where contributions go in after tax. You have tax-free growth and you have tax-free distributions in your retirement years. So we have some clients that feel strongly that their return on investment is going to be significant enough where they don't want a tax deduction now. They want to get the taxes out of the way in the seed so they don't have to pay it on the much larger crop. So diversification and tax advantages, tax efficiency are the two primary purposes or reasons why individuals even consider utilizing a self-directed IRA or self-directed solo 401k, or even we don't want to forget about the self-directed HSA.
Okay, that's a whole nother animal, isn't it? The self-directed HSA. Yeah. Okay, so maybe we can touch on that, but I want to shed some light on this for anybody who doesn't understand. It still is a long-term investment, right? So when you invest within your IRA, it's not like you had some phenomenal win and you liquidate it and use the money to buy a houseboat or something, right? I mean, it is within this structure that needs to be held long-term.
I'm glad you brought that up, Matt. They could be short-term investments or long-term investments. It really depends on what the individual is investing in. But you bring up a really good point, Matt, because most of America, when they think about an IRA or they think about a 401k or even their HSA, you'll hear people sometimes say, I invested in my IRA or I invested in my 401k. What we're actually doing is we're making contributions to IRAs and 401ks. Or 403Bs, depending on how the person is working, who they're working for. Could be a 457, could be a TSP. So they might have a workplace retirement plan, and they're contributing to that workplace retirement plan through their payroll deferral. So every paycheck, money goes out and it goes into this account. And a lot of people think that they're investing in that account, but what they're actually doing is they're taking money from their taxable pocket and they're putting it into their tax advantaged pocket, their retirement account, 401k, IRA, whatever it may be. And then from there, that money is invested. Now, it could be a scenario where they don't invest the money, it just sits in cash. Well, now we have the erosion effect of inflation, right? But most America does what? They take that money and they invest in the mutual funds that are offered through that particular plan or program. In fact, well over 50% of America's retirement accounts, IRAs and 401ks, are solely invested in mutual funds, not invested in real estate, private equity, and all of these other types of opportunities. So it's important for folks, I think, to understand that when they're putting money into a retirement account, they're not investing in the retirement account. The money is going in and then they're investing in something. And that something is oftentimes mutual funds, because that's how most financial institutions are set up. Most financial institutions will not allow you to take control and invest in real estate, private equity, and all these other alternative assets that we're talking about. And that's where an individual would need to make a shift. So they would need to move their account to a self-directed custodian, which allows them to unlock that potential and allows them to be in control and be able to invest in the types of alternative assets that they deem as a good fit for their portfolio, not what a financial advisor or someone else says is a good fit for their portfolio.
Yeah, that's great. So it gives the individual far more control over what they want to participate in. I think there's an element of it needing to be arm's length as well, which maybe you can describe. But the term I used, I'm realizing as you clarified, it's not necessarily a long-term or short-term investment. It could be either, but the money is within that shell, so to speak, right?
Yeah.
Okay.
Yeah, Matt, I'm glad you brought that up, because alternative investments could be short-term in nature or they could be long-term in nature. I'll give you a couple examples. So private money lending. One of the ways that I self-direct my retirement accounts is through lending money secured by real estate to house flippers. Those are shorter term investments, anywhere between 12 months to 18 months. Now, the investment strategy that I deploy doesn't necessarily mean it's the right investment strategy for anyone on this call, right? Everyone needs to look at it through their own facts and circumstance. Equity Trust does not endorse or recommend specific investments. But one of the ways that I've created wealth and preserved wealth and saved a lot on taxes is by lending money secured by real estate. And those are, again, anywhere between 12-month to 18-month loans. So you would argue that those are shorter term transactions. But I have to wait 12 to 18 months, of course, to get my money back plus interest. So it's not like I'm investing in a stock or a mutual fund where there's a lot of liquidity, high liquidity, where I can easily go to a marketplace, right, the publicly traded markets, and put in a sale request or call an advisor or the financial institution I'm working with and put a sale request in and get that money back within just a couple business days. That's not the way it works with alternative investing. Now, hopefully, with that, you're getting what is referred to as a liquidity premium. So if you're investing in these types of alternative assets, arguably you should be making a better rate of return than what you could be making in a more liquid investment, such as a money market account, CD, or individual stock type investment. You then work your way a little bit further along in terms of the alternative assets, and then you get into investments like private equity or private stock investments. So when investing in startup companies, pre-IPO companies, private equity, generally you have a, call it lockup period, where you make your investment and you can't just get your money back the next quarter or the next year, or sometimes even the next 3 years. For example, we have clients here that use their IRAs and solo 401k plans and HSAs to invest in real estate syndication. So multifamily real estate syndications. And generally, when you read the private placement memorandum and the offering documents, it's very clear that you can't get your money back until the management, the GPs, general partners, approve you to get your money back, or there's some sort of financing event where they either sell or they refinance and pay you back some or all of your principal and of course, the previous period's distribution, quarterly distribution. So there are those lockup periods and the illiquidity factor that you have to consider. Cryptocurrency arguably is a little bit more liquid, right? At any time, you could put a liquidation request in and you get your cash back. However, you also have to understand the volatility of the crypto markets, right? And so if there's high volatility in a specific asset class, maybe that asset class goes down by 20% for, let's say, a month and a half. Well, if you need to liquidate in that period of time because you need to get access to that money, or you want to make another investment that you think is going to be more prudent for you, well, you have to take into account that volatility factor. So there's a lot of considerations, of course, as we're talking through here, and variables that you want to consider. Ultimately, the big why and why investors do this is because they feel that there's a better opportunity for them based on their individual facts and circumstances.
Yeah, well, and what you describe is exactly what I did because because the funds I directed into a multifamily. Interestingly enough, for me, what's in my retirement account is long-term money because I'm not supposed to touch it for many, many years to come. It stays within that vehicle, and so I'm less worried about a slight up and down or whether it's contributing significant dividends because it's money that's tucked away for a much later date. And for me, that provides a level of comfort that I use differently than other types of funds for investment, right? If it's coming out of my checkbook and I'm investing in something right now, typically I'm anticipating a return on investment as soon as possible and I want it to continue. And my retirement account, my attitude towards that is different, right or wrong. But my guess is it's true for most people because whether the investment is short-term or long-term, the vehicle is long-term for most people.
Yeah, what you're saying, Matt, traditional financial wisdom would say that some longer duration investment opportunities might be, and I emphasize might be, a
Right.
better fit for your IRA or 401k, those longer duration investment opportunities. Some of it also has to do with where your wealth is at. So I'll give you a great example, Matt, and I think this might relate to a lot of the folks that are part of your audience that are buying and selling businesses. There are some individuals that have worked in corporate America their entire life, and a vast majority, and when I say vast majority, I mean sometimes I see 90% of someone's wealth, not including their primary residence, right? We don't include that, but 90% of their wealth is all tied up in a corporate America 401k. And when I say a good chunk, I mean like 2.5 million. And they have this large chunk of money in their 401k. Maybe it's also them and their spouse. And they leave corporate America and they say, hey, I want to start a business. But 90% of everything that I've saved is in my 401k at my old job. So what are my options to be able to go start a new business? And this is where some individuals utilize the structure that we talk about quite routinely, which is a rollover business startup, a ROBS structure, where they might consider rolling over their 401k money into a solo 401k plan or potentially just an ERISA 401k, we call it. And then that 401k buys shares of a C corporation, and then that C corporation would run a business or buy a business. Now, that's a more advanced topic of conversation, but it is call it sibling or cousin to the self-directed IRA. And really the foundation of it is a self-directed 401k that's buying shares of a newly formed C corporation. That C corporation is run by you, let's say the business owner, this person from corporate America. And that's how they're able to unlock their retirement account and be able to launch their next business venture. So we see circumstances like that. Going back to the original point of the conversation, I think it's important that folks consider that everybody's in a little different situation. Some people are like you, Matt, which is you have this money in a retirement account. You want to protect it. You want to preserve it. You want to keep it growing, but it's longer duration for you. You have a little ways before you turn 59 and a half and you retire. Whereas other people, they might be 59 and a half or 60 or 65 already. And so they might actually be investing their retirement account in shorter term investments, or some are shorter term, some are longer term, because they need the liquidity. They actually need to live off of that retirement account. So everybody's a little different. Age is a big determination. Amount of money you have in the retirement account is a big determination. And then, of course, your skill set on investing. Do you have a skill set to invest in real estate syndications, individual property investments, private money lending, cryptocurrency? And do you have the passion to control your own retirement account? Some people, let's face it, Matt, they just are willing to be at the mercy of someone else advising them on where to put their money. And that's the way they want to operate. And that's okay. We can't, change those individuals' minds, nor should we try to do that.
Yeah, well, there's a lot there. And the core competency, the ability to actually manage the investments, and the desire is a factor. When you bring up Rob's, I deal with, matter of fact, I just closed the transaction, helped the gentleman buy a business using his Rob's account because he fit exactly what you just described. And it works out beautifully because, again, that's the intent. But can you walk us through, for our audience, who a lot of people might be in a very similar situation of wanting to buy a business using those funds? There are some rules around what amount of money can be paid out of that investment and what needs to stay in the investment. And I don't want to speculate on some of those details, but the gentleman I just sold a business to is going to take a salary from the investment that he made through his Rob. So can you walk us through some of those high level details so people can get their arms around that?
100%. I always like to use the example of an RV park. And interestingly, you go around the country, and I have a camper, so we go to RV parks, and I'm always curious when I talk to my wife, especially those, like KOA type franchises. I'm always like, I wonder if this is owned by a Rob's. I need to find the owner and talk to him. So this is the way it works. We'll use an example of an RV park. Let's say we have an RV park, and let's just use $5 million as the acquisition price. And we have an individual that leaves corporate America, and let's say they have $2 million in their 401k from their corporate America job. They leave and they decide they want to invest, and I shouldn't just say invest, but they want to buy this RV park. And let's assume that they're going to buy it. They're going to put in systems and procedures, and they're going to utilize their skill set from corporate America. They're going to roll up their sleeves, and they're going to run the business. And so that's a scenario where they wouldn't be able to just use their 401k as is and go buy that RV park and roll up their sleeves, because they would actually trigger what's called a prohibited transaction. So they have to use this specially designed structure, working with the right financial team members and the right attorneys and CPAs to create what we call a ROBS structure, rollover business startup structure. So using my example of this RV park, individual rolls over $2 million from their 401k at their old job into a newly established 401k. That newly established 401k is sponsored by a C corporation. It can't be an LLC or an S corp. It's got to be a C corporation. So simultaneously, they create a new C corporation and they create a new 401k that is sponsored by that C corporation. They roll over their corporate America 401k, $2 million, into this newly formed 401k plan. Then they go to, let's say, an SBA lender, and the SBA lender loans them $3 million, or rather loans their corporation $3 million. See, that's one of the problems. SBA lenders, they'll say, well, wait a second, you don't have enough net worth. We can't loan you. Interestingly, SBA lenders are one of the biggest referral sources for companies that do these ROBS structures. That's how I learned about it years ago. In fact, Matt, I knew nothing about ROBS until I started talking to these SBA lenders, and they said, oh yeah, we just refer them over to this company. They set up this ROBS structure, and then we can make a loan. We can do an SBA loan. And so using our example, we now have this individual that has their 401k money that owns nearly 100%, is usually the way it's structured. The 401k owns nearly 100% of this C corporation, and our owner is going to be the CEO of that C corporation that owns the RV park. That owner, they need something to live on. So what are they going to do? They pay themselves a salary. Now, under the 4975C prohibited transaction rules, it would be a prohibited transaction. But then we have IRC 4975D13 that essentially trumps the 4975C rules. Not to get people lost in the details of the tax code, but it's important to understand that you have the prohibited transaction rules and then you have the exemptions to the prohibited transaction rules. That's how a ROBS works because you have a 401k that owns shares of a C corporation. Yes, you have to pay a 21% corporate tax, but all of your dividends go into your 401k and are tax exempt. Now, for folks that can do it the right way, I shouldn't just say the right way, I should say a more optimized way, they can actually have all of their money converted to the Roth side of their 401k. That way, all of their dividends are 100% tax-free for the rest of their life. So they're building their 401k, they're taking a reasonable salary to live on, they're growing a business, and they're growing their retirement account. So this rollover business startup structure can be incredibly beneficial for people, again, that leave corporate America, want to try to bootstrap the purchase of a business using their 401k money and do it in a permissible way. Again, they have to make sure they work with the right CPAs, the right attorneys, the right companies to set all this up. But if it's done right, it can be really, really effective and it can be really tax advantaged as well. And then all of that being said, to kind of conclude on this point or topic, Matt, there can be ways for a business owner, if they don't want their 401k to essentially own that business for eternity. Maybe they're going to run that RV park for the next 30 years and they say, hey, I don't really want my 401k to own this business completely. There are ways in which they can strategically, we call it unhook the 401k from that. So now they can put themselves in a position where their 401k is not singularly threaded in their business, and they can actually start diversifying that 401k money into other types of investments, whether alternative investments or just invest in the traditional stock market.
Well, I really appreciate how thorough you went through that, because it's a tool that I would say probably 5 or 6 of my clients use every year. And the gentleman who just closed on a transaction was very similar. He obtained an SBA loan, but because the SBA lender was a cash flow lender, he was only required to put down, I'm gonna call it $300,000 of his retirement account for the purchase. Then the lender did the balance. So he still has this very significant amount of money within his retirement account. And yet, I guess just to use a simplified term, I mean, he created a C Corp, as you described, and bought stock in that C Corp, which he now controls. He should have far greater returns from controlling his own stock than what he might be able to get through a traditional investment, which I know is what we're balancing against here.
Yeah, exactly. You hit the nail on the head, Matt, which is, that individual obviously believes in themselves. They believe in themselves, they believe in this business, and they're putting a lot of sweat equity into the business. And what better way to grow your retirement than your horsepower and your sweat equity? And that's the way a lot of our clients approach it. When self-directing an IRA or 401k, in some instances, individuals just want to do passive investments where they're not operating the business and, if you will, rolling up the sleeves is the way I always like to say it. They want to be a private money lender. They want to own some rental properties, maybe an occasional Airbnb or an occasional flip, or investing in private equity type opportunities. And in those instances, they would invest directly out of their self-directed 401k or maybe self-directed IRA or self-directed HSA. And for some people, they're doing both, where they have a ROBS that's running their business. Maybe that's a consulting company. Maybe that's an RV park. Maybe it's a car wash. We see that done with ROBS as well. There's all different applications that we've seen with ROBS. And then in addition to that, as they build up money in their 401k, they're not just going to have that money sit in a money market account. After all, a lot of entrepreneurs and self-employed people and real estate individuals, what do? They focus on the next opportunity. They focus on the next alternative type investment, not being singularly threaded in the stock market. And so those individuals tend to want to take that money that they're building up in that 401k and self-direct it into multifamily real estate syndications, like you had mentioned, cryptocurrency, precious metals, other private equity type opportunities that are more passive for them. and they can easily do that directly through the self-directed 401k.
Yeah, that's great. Well, it's a very powerful tool. And so if somebody wants to go down this road, how do they get started? And I'm also going to add, there's a point where financially it doesn't make sense, right? Because this is a structure that requires some minimum investment amount to make it worth the cost. Is that right? Can you walk us through that as well?
Yeah, that's a good point, Matt. Do the economics make sense? Because to set up a ROBS structure, and to put it in perspective, a self-directed IRA or a solo 401k plan, the annual cost to pay a custodian or an administrator or service provider, you're looking at anywhere between $750 to maybe $1,000 on an annual basis, right? It's pretty straightforward. With a ROB structure, you're looking at the necessity of creating a C corporation. So there's a cost involved with that. The 401k, which is not just any off-the-shelf 401k. It has to be an appropriate 401k for your specific needs, especially if you're going to have employees in that business. And then you have an annual C Corp tax return. You have valuation of stock that has to be performed on an annual basis. So there's some annual administration work and some setup costs that you need to consider. Now, in terms of ballpark figures, I see anywhere between $5,000 to $10,000 to get the whole ROBS setup structure done and done correctly. Mm-hmm. You might find some firms out there where it's $3,000, $3,500. Well, that's off the shelf. What you have to add in is the cost to have your CPA do the tax returns, any certain types of filings that have to be done. So you have to be considerate of that. And so when you think about that cost, an annual cost, you're anywhere between maybe $2,000 to $3,000 on an annual basis. And so call it $6,000 to $10,000 startup and $2,000 to $3,000 on an annual basis. So you take that number and you look at, okay, what's the profitability of this business venture? And you should be able to come up with a good conclusion as to whether it makes sense for someone to do this or not. You know, some people ask me, is there a minimum probability that I need to make in order for this to be justified? Can't really give that number, but there you have what the annual costs are involved here. So we want to make the juice worth the squeeze, of course.
Well, and there's the offsetting piece, which is in the example you provided. Somebody's, 90% of their net worth is tied up in their retirement account. If they just liquidate it to buy an asset, then they've got taxes and penalties and all of those things depending on their age as well, right? So it is a cost that preserves the cash or the value to some extent as opposed to the alternative.
Yeah, absolutely. You have to you have to look at the tax savings. Mm-hmm. You have to look at, of course, with retirement accounts, especially 401ks, ERISA 401ks that's usually what's used with these ROB structures. There are some unique creditor and bankruptcy protection associated with those types of 401k plans. So from an asset protection perspective, the account avoids probate. It's left to your children or grandchildren. So there's all of these interesting benefits associated with 401ks and IRAs that we don't always talk about because we usually focus on the ability to be able to diversify and control, and of course, the tax efficiencies that we talked about. And the tax efficiencies are something to double click on because, for example, with a Roth 401k or Roth IRA, your growth is tax-free. And when you distribute the money, you pay 0% tax. And when you leave it to your children or grandchildren, they can continue to grow that Roth for 10 years tax-free. And then they can take it all out 100% tax-free.
Wow.
So from a legacy planning perspective, from the perspective of hedging against future tax rate increases, hedging against even inflation when you think about it, because let's face it, inflation does what to tax brackets? Right? It increases the dollar amount in each one of those tax brackets. We see that happen almost every single year. Mm-hmm. And so when we think about hedging against inflation, hedging against future tax rate increases, a Roth IRA or designated Roth component to the 401k can be really, really powerful. Unfortunately, Matt, and you've heard this before, too many people are led to believe that they're not allowed to have a Roth IRA because their income is too high. And that's why we talk about the approach of what is referred to as a backdoor Roth contribution, where you contribute to a traditional and convert to a Roth, or you take your traditional money you have now, convert it to Roth, pay the taxes now so you don't pay it later, or you set up a 401k, which could be a solo 401k plan or just a 401k for you and your business and your employees, and you start making after-tax Roth contributions so that way you can take advantage of tax-free growth and tax-free distributions in your retirement years.
There's so much there, which is part of the advantage of your knowledge, of course, in equity trust is being able to navigate that. You certainly wouldn't want to connect with somebody who doesn't know what they're doing in this area. So how does somebody get started if they're interested in this? What's the first step, and what mistakes should they avoid?
Yeah, so I would say as far as self-directed IRAs, solo 401k plans, HSAs. So for those out there that are simply looking to maybe buy a rental property with their retirement account, or invest in a real estate syndication like you referenced, or private money lending, cryptocurrency, precious metals, that would be a service that Equity Trust can help you with and support. So it's as simple as just reaching out to us. You can go to our website. We have a YouTube channel, lots of education out there. You can call in, speak to one of our associates, and we could, of course, help you with that. So that's pretty straightforward. That would be for those that want to passively invest in those types of alternative assets, maybe roll over an old 401k, transfer an IRA. You don't have to transfer all your money, maybe just a portion to get started. That's fine. For those out there that say, hey, I really like that concept of a ROBS, a rollover business startup. I like the idea of being able to roll my 401k money over or IRA money into this 401k structure to be able to buy a business. I want to do that. In that particular instance, that individual's next steps wouldn't be to come to Equity Trust, but you're going to want to do some research in the market on ROBS providers, ROBS, rollover business startup providers. There are not many different providers. There's, I would say, a handful of providers. And some providers offer different services depending on the types of businesses you're buying, the types of structures you're looking for. So do your due diligence based on your individual situation, the type of business or businesses that you want to buy and operate, have the conversations with the different ROBS providers, and they'll be able to tell you if they can accommodate your particular situation or not. And then just move on to the next one. If one doesn't work out, move on to the next one. So that would be the next steps for that type of individual.
Okay.
And of course, when they're having the conversation with these different ROBS providers, be sure that if you have an attorney involved, if you have a CPA involved as you're looking at businesses, if you have a business broker involved, right? Make sure that you have that person involved. If they're working with someone like you, Matt, they should be telling you that, hey, I have a serious interest in using a ROBS, because that could change things in terms of the negotiation, that could change things in terms of actually acquiring the business. And of course, you have a seller that might look at this and say, hey, that's kind of interesting. The C corporation is 98% owned by the 401k. And I will tell you, this may have happened to you before. It's happened to me when I close on real estate deals and people see I'm using my self-directed IRA. What should have been like a 15-minute conversation to sign a purchase contract turns into like a 2-hour meeting at a coffee shop. And what do they want to know? They want to know how to do it.
How to do the exact same thing.
Because of the tax savings and the ability to be able to leverage my retirement account. Then it turns into a 2-hour conversation. So I guess that's a, maybe an interesting byproduct and beneficial byproduct beyond just what we're talking about here. But those would be the next steps, I would say, Matt.
Okay. And any pitfalls that somebody should watch out for when they're going down this road? And let's look at the IRA specifically. The ROBS is a whole nother conversation. But what do you see? Where do you see people make mistakes when they start this process?
Yeah, with self-directed IRAs and 401ks, the number one mistake is an individual has an investment opportunity that they identify, but they don't have the self-directed IRA or 401k established yet. So they have to make sure that they have the account set up and funded well in advance of pulling the trigger on an investment opportunity. It doesn't take months, but it can take a couple weeks to have your money transferred or rolled over from another financial institution into the self-directed IRA. So timing is really critical. That's one of the mistakes we make. The second thing that you want to be considerate of, are what we call the prohibited transaction rules. So governed under tax code 4975, there are acts that can result in a penalty. So the IRS, the government, doesn't allow you to do certain things with your IRAs or 401ks. These are called prohibited transactions. The good news is the law is exclusive, not inclusive. So the law only tells us what we can't invest in, not what we can invest in. And that's why we can invest in all of these interesting alternative investment opportunities beyond Wall Street, like private equity, like real estate, like crypto, because again, the law is exclusive. So what are some of the things you can't do with your IRA? Well, I can't self-deal. So I can't, let's say, use my IRA to just inject money into my own business that I have right now. That would be a prohibited transaction. I can't use my IRA and loan money to myself or my spouse or my children because certain family members of mine are also considered disqualified persons, and I cannot transact my IRA or 401k with those individuals. I can't buy a vacation rental property and stay in that property 3 days out of the year. That would be a self-dealing prohibited transaction. So these are in many cases common sense when you think about it because they're highly tax privileged accounts. So for obvious reasons, the IRS and the government, the spirit of it is to benefit the IRA in the long term, if you will, of the IRA and not benefit myself personally in the here and now.
Yeah, it's funny you some of those examples you bring up. I can imagine that somebody actually came up with that and tried it, which is how it ended up on that prohibited list. So
yeah, it's we get those questions every day because people hear a self-directed IRA and they're like, "Oh wow, I can tap into my retirement account and maybe bail myself out of a financial situation I have or inject money into my business without having to pay taxes." And unfortunately, I wish it was that easy. The good news is, again, there's a lot of opportunity with it as long as you learn about it and follow the rules and execute with a strategy.
Great. Well, I appreciate that. Well, the information is so valuable. And I've got one last question for you, which I ask all of my guests because it's so easy for listeners to see somebody on a screen or hear them and just feel like they must just be way smarter or way more talented. But most of us have been given a hand up along the way. And so can you share with us a story about somehow you got a hand up to be as successful as you are in this industry and with your investing? Just who helped you along?
Yeah, absolutely. Our company founder, Dick Desich, who's widely known as the pioneer of the self-directed IRA industry, he and then his two sons, Rich Desich and Jeff Desich, all three of them are and have been for many years and still to this day mentors to me. I've learned a ton from them. They built our business from very humble beginnings. Dick Desich he grew up poor and he went to college. He joined the Air Force and paid his way through college, became a stockbroker, and built the business. And my upbringing was more in a blue collar type household, and my father he and my mother really wanted me to go to college. They said, we don't have the way to pay for it, but you can pay for it, and there's ways to do that, and we figured it out. And so went to college and went through that process and got interested in finance and financial services and. Here I am today. And so if it wasn't for, my mother and father for that encouragement, and then for the Desich family, I probably wouldn't be doing what I do today. And then along the way, I've met a ton of very intelligent, some of them, Matt, a ton of very intelligent tax attorneys, CPAs, consultants. I have a good friend and consultant to me that I reach out to when I have unique, odd IRA and 401k type questions. So I'm just trying to learn every single day. I learn a lot from clients because they have unique, interesting situations that sometimes I haven't seen before. And so I go out and I start doing research. And that's really what I enjoy doing. And some of the free time that I have to help my clients and help myself is doing deep research on different topics. For example, yesterday, I was preparing for a webinar on HSAs, and there's something with HSAs where you can reimburse yourself for previous year's healthcare related expenses. And so, of course, I wanted to make sure that it's defined in an IRS notice that you can do this. So I was fortunate enough to be able to locate the specific IRS notice that says that you can do this. So ultimately, that's a little bit of more of a rabbit hole conversation for folks that maybe want to tune into that level of detail. But those are the types of things that I do and the types of people that have impacted me over the years. And, Matt, you would certainly be someone that has made an impact on me over the last year in terms of business acquisitions and learning about how that works, which was a slightly newer world to me going into it. So I appreciate your mentorship as well.
Oh, well, thank you so much. That means a lot to me. And I when I've listened to you speak and present, and I know that you've got a lot of material out there that people can find. I mean, your level of depth into this industry is just like none I've ever heard. So I really appreciate you joining us and sharing your insight with us today. And I'm glad people know who you are and know how to find you.
Yeah. Thank you, Matt. See you soon.
Okay. Sounds great. Thank you. Well, that's today's episode. I hope you've learned a whole lot with John. The content is very deep and rich, but so valuable. If you can get your arms around how significant this can be to build wealth for you and your family and your generational wealth, it is very, very powerful. So I hope you enjoyed it, and we'll see you on the next episode. And that's a wrap on today's episode. We hope you enjoyed the conversation and got some valuable insights into the world of buying and selling businesses. Want to be a guest on our show? If you have a deal that you'd like to discuss with us or a business story to share, we'd love to hear from you. Shoot us an email using the contact information below in the episode notes, and let's make this happen. Never miss an episode. Make sure you subscribe on Apple Podcasts, Spotify, or wherever you listen. And if you found today's episode helpful, please leave us a review. It helps more people like you find the show.